Welcome to this update with SKAGEN Focus. It's myself and David Harris that's going to present today. And as this picture implies, you'll notice that the investment environment has been pretty chaotic and pretty unpredictable as of late. The year started with a severe correction in higher multiple stocks, primarily centered in the US technology stocks and also in the Chinese technology stock department, which has also continued. But of course, the Russian crisis also created a huge uncertainty, and that's created some very interesting movements within commodities and resources, for instance. And we're going to go through our exposure and how we are positioned in this environment in this presentation. We're also going to take a look at portfolio construction and new portfolio positions in this as we go along. I also want to highlight we have received questions on our Russian exposure, and I can say that we have had zero exposure to direct Russian equities in this environment. So just for the record. So if we move forward to the mission statement of the fund, what is SKAGEN Focus trying to achieve? What are we trying to achieve for you as unit holders? Well, our mission is to find these hidden gems, these substantially undervalued companies out there, which exist, we think, primarily in the small and mid-cap space in global equity markets, but also in exceptional cases in large cap positions. We have right now currently about 80% plus in small and mid-cap positions, about 20% large caps. This can vary over time. But we look for a substantial discount to fair value. We exclusively invest if we can identify at least a 50% upside in the equity price in 2 to 3 years time horizon with a normalized and steady state earnings power. So we don't give much credit to growth assumptions far out in the future. We like growth, but we don't like paying for growth. So this is a very strict investment criteria for us when it comes to picking stocks. I also want to highlight that we have a green transition investment theme integrated in our investment process, and it's a natural building block to find these hidden ESG gems as well out there in global equity markets. So if we're going to move into the Russian theme of things, let's take a look at the Russian share of global production in certain raw materials. And you all know, of course, that natural gas and oil are primary export commodities from Russia. Russia is actually one of the largest net exporters in the world in these commodities. And we have seen the price implications in those commodities over the last few weeks. But what is perhaps less known is their dominance in palladium, for instance, and platinum. Palladium is almost half the world's production in Russia, which is now coming to a close, or at least a temporary close. So, and this goes into cars, the emission control devices when you produce cars like hybrids or traditional cars. So that's going to produce an interesting or a difficult situation for certain auto parts and auto companies, of course, as costs skyrocket. You'll see they're also quite big in gold, which is not perhaps necessarily that known as well. The gold price follows a certain other path. But this has also, we think, affected the gold price on the margin. We're going to take a look at that on the next slide. And they're also very, very large producer of nickel. And nickel is a prime component into stainless steel as well as EV batteries, which also makes for a much more expensive production structure for many industrial companies across the globe, of course. And if we take a look at the next slide, you'll see how these commodities have behaved as of late. This is a chart going back to 2002, rebased, and interestingly, you see the green line here, which is the nickel price. Actually, it was at a similar level in the China super commodity cycle at the end of 2007. It now spiked just the other week. It went up more than 100% in the mother of all short squeezes, if you will, in nickel. Now it has retraced a little bit, but the prices are clearly extremely elevated in nickel. You see palladium has increased vastly. That's the gray line. Interestingly enough, there's a spread to the platinum price. We follow that pretty closely. Platinum is mainly going into the diesel cars, which explains some of the oversupply that's been hanging over the platinum market is also a reason for this spread. And you also see that the gold price has put in a new fresh high in this environment, of course, driven by the uncertainty and also by Russian buying of gold, if I'm not mistaken, central banks buying gold structurally. So this is clearly affecting global equity markets. It creates an inflationary environment. And we have an interesting exposure to these themes across the portfolio. If we take a look at the next slide, you'll see that this is only a few of our basic materials or commodity names. We have about 20% plus in the portfolio in commodity and raw materials. And we have spoke many times about Ivanhoe Mines, and palladium is actually it's going to be one of their producing commodities. Not now, but when they develop the Platreef asset, it's going to be also platinum and nickel. Their main asset right now, which is producing, is copper, of course. The Kamoa-Kakula is going on stream, both phase 1 and phase 2. So we still find Ivanhoe Mines very undervalued and an interesting asset in this environment. Fortuna Silver being a gold and silver miner. It's about a 3% position currently. Together with Argonaut Gold, we also hold Endeavour Mining, another gold producer. So we have a pretty interesting exposure to these undervalued miners. We don't need these price commodity to rise from their normalized level to see our upside in these equities. So that's how we value these names. We don't use the spot pricing deck. For instance, in nickel, the nickel price actually sparked a very interesting price increase in the equity of Vale Indonesia, which has been almost a 3% position in the fund. We cut it in half as it rallied last week, and now it's a 1% plus position only. Yeah, come down a little bit since then. And you also see that we have exposure towards lumber in Canfor. Russia being a very large lumber producer as well, for instance. Half of Canfor's production, they're based in Canada, but half of the activities are actually in Europe these days. So they're benefiting from a very high lumber price as well. And same Canfor Pulp being soft pulp producers, softwood, respectively hardwood pulp. And this has also been seen, the price trends in pulp has also been very strong and was even before the Russian crisis hit. So we have quite a interesting and I think appropriate exposure to this theme across the fund currently. And what is all that? What this commodity price rises? What does that mean? Well, of course, it will only reinforce the trend that we had since before with the consumer price or the inflationary pressures across the economies. This is the US CPI change year over year. And this was before the Russian crisis, basically. This number hit a 7% year over year increase. And this commodity price situation will only reinforce this and put the central banks globally in a very difficult position. On the other hand, the Russian crisis will perhaps slow down economic activity. On the other hand, inflation will sort of accelerate. We don't see any signs that the central banks will deviate from the path from going from this QE easing towards quantitative tightening. And there's a wide expectation that they will withdraw the QE bond buying and now start hiking interest rates, as many economies already have done, like Korea and Eastern Europe have had many interest rate increases during the last 6 months, for instance. So you'll see that this environment creates a totally new sort of ball playing field for equity investors, and we think this will become a much more easier or a much healthier equity environment for active contrarian value funds like ourselves in the coming years. And you see that this is not only about rates, it's also about earnings. The rate cycle is now sort of changing investors' behaviors and preferences, but the earnings cycle is also changing. This is the EPS number relative terms for the world outside the US versus the US EPS number. You'll see that the momentum now is clearly changing. Several high-profile, very expensive technology names in the US, for instance, like Meta or formerly Facebook, recently warned that growth is no longer present. That collapsed the multiple in that name. That's a huge component on the S&P 500. And a lot of software names have also experienced the same thing in the US. So you'll see that it starts to shift. On the other side of the planet, you'll have KB Financial, one of our largest bank positions, now creating very interesting earnings growth since the short rates are rising in Korea. They're expanding their profit base, being a very healthy and extremely undervalued bank in Korea. So the capital flows are, I think, turning here, which is an interesting observation. And this also makes for a turn in some other variables, like how investors view so-called value versus so-called growth. The growth component now not being as present as it were in these select 50, 60 global names that has been the market has been very narrow in focusing on these names over the last 10 to 12 years, really. So now you see a broadening effort from investors, and also they are now looking at the more ignored and the more discounted parts of global equity market is suddenly coming into favor. And this has been the trend for the last 6 to 12 months, really. And the rotation potential is still very, very high in our opinion. So just to sum up, we think the Russian crisis has created just reinforced the tailwinds for commodities that was present before this crisis. We might be entering a new super cycle for commodities, really, not driven only by these temporary factors, but the green revolution for this planet is also creating investments for companies that needs to be transferred to clients. And this is really something that is inflationary. It's a structural inflationary component that I think is hugely underestimated among investors. And that's something that's going to drive inflation for years, most probably. And this is creating totally the investment map turns upside down. QE is replaced by QT, quantitative tightening. And you'll see investors be more interested in buying above average free cash flow near-term yields rather than far out in the earnings curve. And that's exactly what SKAGEN Focus is positioning. That's exactly what we're looking for, is these undervalued near-term cash yields that mainly SKAGEN Focus consists of over time. So we think we have a very interesting positioning in the fund here as we move forward in this new investment cycle.
All right, and we move over to the investment process before we go over to changes in the fund since our last update. So as we are all aware of, we live in a world that's constantly changing, and some days it feels like, in some days the world is changing more than other days, and on other days it feels like the world is changing more than it actually does. But what's fairly constant over time is our investment process, which has been the same for many years now, and it's price driven. Our aim is to identify substantial discounts, and we only take in positions when we see a discount of 50% to fair value, while trying to avoid permanent losses of capital. So we think of our process as robust and steady as we move forward, and from this perspective, well positioned to discover ideas that come along the way as markets constantly change and mispriced opportunities occur. Idea generation for us is much a very creative process, and there are many different ways for us to identify new ideas, and I just want to highlight a few of them. Of course, screening is a tool that we use quite often, almost on a daily basis, in order to spot the different fundamental changes that we think could be attractive. But I also want to highlight ecosystem, which is something that we find very lucrative in terms of new ideas. Often when we make the decision to research a company a little bit closer, you often have to look at the entire ecosystem in which the company operates in. And this includes its customers, its suppliers, and the whole value chain that the company operates in. And often we find ourselves investing maybe in a completely other part of the value chain than we initially thought was attractive. So this is a very lucrative work that we do and generate many type of ideas. We also have time arbitrage. We've been doing this together for quite some time now, and using the same process, and we have a library of thousands of research folders, different companies that we have met and done work on over time. And this is something that when markets change, it could be something very useful and enables us to act quite swiftly sometimes as market changes. And we believe the discount is unwarranted. And then I also just want to highlight sell-side research. This is something that very seldomly gives us direct new ideas, but something that is very useful for us to benchmark our assumptions and ideas as we work with idea generation. So if we move forward then and come into new additions to the fund lately, we have established a couple of new positions since our last webinar. We have established a position in Iveco, which is a commercial vehicle producer. The company was spun off from CNH in the beginning of this year, and it's an unknown entity for financial markets as a standalone unit. There was a lot of technical selling pressure at the spin-off from index fund and other non-fundamental investors, which put more pressure on the stock and uncovered this very interesting price point for us. The company has a lower margin profile if you compare it to peers such as Volvo, but we believe that the market is completely overlooking the cash flow potential in the midterm for this company. And we also see a potential for them to improve their profitability over time. And if we take a look at the industrial part of the company, so taking away excluding their financial operations, we see a very strong balance sheet. In fact, they have a net cash position of almost 1 billion euro. We have also added Sammartino to the fund, and for those of you who have been with us for some time, maybe recognize the name. Sammartino is a well-managed, low-cost producer within the sugar and ethanol industry. They operate best-in-class assets. They have a very strong balance sheet and generate very attractive free cash flow levels, which we think increases the possibility for them to increase shareholder returns. They're also very well positioned to benefit from current price levels, both in sugar and ethanol. In sugar, we see a structural change that benefits them in terms of demand and supply dynamics that have improved for sugar, but also for ethanol, which of course is correlated to gasoline prices, but also has seen a higher demand as a more environmental friendly source of energy, especially with regards to reduction of CO2 emissions. We have also established a position in Stelco. Stelco is a Canadian small cap steel producer. They operate assets formerly owned by US Steel, which went through a Canadian bankruptcy before they were acquired by Stelco's sponsor. This is a company we think still is very much under the radar. But the company has emerged from this restructuring process, which much reduced liabilities, a much stronger balance sheet, and have significantly benefited from the higher steel prices we have seen lately, which enabled them to generate significant amounts of free cash flow levels. And even as we expect steel prices to go down from here, we still think that they can generate significant amount of shareholder returns in the coming years. They recently bought back 30% of outstanding shares, and we expect them to continue to do buybacks as indicated by management. And management themselves are quite substantial shareholders, especially the CEO, which we think is a good incentive and a good place to be for us. We also think consolidation could be a theme here, as Stelco's assets could be quite attractive from a consolidation perspective and a target for other companies. We also want to touch upon Cascades. We covered Cascades during our last webinar. This is now our largest position in the fund. We see very attractive risk reward. Cascades is a packaging and tissue producer listed in Canada, but most of all, we think it's an undiscovered gem in the circular economy, as more than 80% of their inputs, the input fiber, is derived from recycled fiber. As recycling is a large part of their operation. In fact, the company started as a recycler. It's family owned. and it has not been rewarded by the market and not gotten the attention we think it deserved. The company has been through a significant turnaround, both in terms of the balance sheet, but also profitability. And they recently held a strategic update with investors, which confirmed the attractive outlook in terms of profitability. They add strategic capex to their profitable containerboard segment, where we've also seen price hike. But we also saw an interesting indication of that the tissue segment is becoming less core, which is also something that we have addressed to the company. And we think that there is a high possibility of a spin-off down the road and a breakup of the company. And we see several catalysts that could support a re-rating for this company. So very well positioned, we think, and very high conviction for us.
Yes, taking a look at the performance numbers here in euro, and this is the 2-year track record now for the fund, obviously when the pandemic bottom hit in March of 2020. And you'll see that what happened really here was the start, we believe, of a new investment cycle. When you stop the entire global economy and then restart it, some strange things happens, and not necessarily does all the pieces fall back into the same place. Which has happened, of course, with the inflationary pressures that has been now evident for most in financial markets, and creating a completely new environment for equity investing than we have seen the last 10 to 12 years. And in this environment, the fund has done very well. It's up over 100%, 112% in euro terms, which is about 50 percentage points above the ACWI index, and also way above the value index, which is not necessarily a very good proxy for our fund, but we're quite proud of that positive deviation from the value index. And as these trends continue, we think we have a pretty good chance at continue to deliver. And we can also notice now that we have a very significant upside in the portfolio towards our accumulated price target across the fund, over 60% upside, which hasn't been seen for quite some time. And it's mainly centered in order parts, for instance, and in banks like Commerzbank or Vitesco and Faurecia, etc. There's a few very decent upside. Iveco we mentioned with over 100% upside, which is a new position in the fund at 1.5%. So that should be highlighted. And you'll see that what has driven performance as of late is of course some of these equity. We'll take a look at the individual equity components, but 2 of these components have been 2 buyouts in the fund. We left 2021 with 5 takeover offers from strategic or financial investors, which is an extremely high number, of course, for in any given year. This year, we have actually received 2, which is the first one was First Horizon, our regional bank, which was taken out by Toronto Dominion Bank at a level which was pretty much equal to our price target of $25. It was a position that was fairly small, unfortunately. We had actually lost some conviction, but of course this offer confirms our investment thesis and the inherent value in that asset. It was a 35% premium cash offer. We have now sold out that asset in the portfolio. We also received a new offer for Stagecoach, which was formerly bid by National Express, the competitor, in a share swap deal, but was way too low in our opinion, and we have held on to that position. It's a 2% position. We now received the 37% premium in cash from an infrastructure fund, which also made the equity go pretty close to our price target, and that position is also sold out. And we'll see if there's any new, we can fill out these blanks as we move along 2022, but fingers crossed, and we'll see.
All right, then let's move over to the major adjustments that we have done to the portfolio since our last update. We've been fairly active, establishing new positions. Iveco, Ence, San Martino, Stelco has been mentioned before. In fact, we have even started to build other positions, but we will disclose them at a later stage. We have increased our position in Fortuna silver mines. We decreased the position before the end of last year, as there was some uncertainties regarding one asset in Mexico. This is a small part of the NAV, and we have gotten more clarity there, and it's more than well discounted. So we have continued to add to that. They have very attractive assets in both West Africa and Latin America, and we have also added to Ubisoft, which has currently trading at very attractive risk reward, and we think offer a very attractive outlook in the midterm in terms of positioning and their asset base. We have sold out First Horizon Stagecoach following the buyout offers that Jonas just mentioned, but we have also closed our position in Japanese regional bank Aichi Bank, which traded had a very nice run towards our price target. So we sold that out that position. And we have also scaled down Commerzbank in the beginning of the year, following a very strong run. We initiated the position at the end of last year, but had a very strong performance. So we took some profit there, but still a position in the fund. We also scaled down Vitesco and Faurecia with regards to the uncertainty in Europe. And we have been taking profit in K+S, the German potash producer. K+S is the strongest contributor to performance year to date. It's a leading potash producer, which is essential ingredients into fertilizers. As Jonas described before, we have seen a very strong price development there. But it's also worth noting that K+S came from a very interesting development last year, where they spun off some of their salt assets, which completely improved their balance sheet. So we think that this, combined with the price levels that they're enjoying right now, can lead to some very interesting capital allocation triggers going forward. Another strong contributor was Vale Indonesia, which we mentioned before, benefited from stronger nickel prices. Now, looking at our detractors, automotive suppliers, Vitesco, Faurecia has been our biggest detractors with regards to their exposure to Europe and the uncertainty there from the invasion of Ukraine, of course. They're trading at very, very depressed valuations, so we might add as we get some more clarity going forward. Just highlighting the compositions of the fund, we currently have 47 positions in the fund. Majority of them are in small and mid cap, but not exclusively. As you see, among our top 10 positions, we have 2 of the top 3 names are large caps. We have Japanese conglomerate Panasonic, but also South Korean bank KB Financials, and this number might change over time depending on where we see the biggest opportunities. You have a concentration among top 10 at 35%, which is where we feel comfortable at currently. And as we mentioned before, we have a significant upside, 65% weighted upside towards our price target across the portfolio. And this is, of course, also due to the freshness of the fund. You see 49% of positions in the fund are less than 1 year from inception. We try to stay very disciplined in our investment process, maintaining this upside for our unit holders. When we reach price target, we sell out and invest and reallocate capital into more attractive ideas from our pipeline. If you take a look at some of the valuation multiples for the portfolio, you see that it's very cheap, trades very attractively compared to any sort of reference benchmark, of course, the world index, but also any type of value index, we believe, but still very high, well-run companies, profitable, return on equity is quite high if you look at the multiple for the fund.
Yes, to sum up, we think we have a pretty unique investment fund in terms of being contrarian, value price-driven investors with focus on global small and mid-cap positions with a green transition investment angle built into the investment process. The commodity rally as of late has actually led us to and allowed us to take profit within the commodity complex of the portfolio. For instance, in Vale Indonesia, which we have sold down aggressively. We have now only a small position left following the rally in nickel. Still have a large exposure towards commodities. We also have a large exposure towards financials, which should be a primary beneficiary of this rate hike environment that we're moving into. We have seen that the portfolio has delivered some very interesting returns in this sort of new investment cycle. It's up over 50 percentage points over the MSCI ACWI and also way over the value index over that specific period. If this environment persists, we think we have very good chance of keep on delivering interesting performance numbers. And importantly, the upside in the portfolio, as we have mentioned, is now very high across towards our target prices across the portfolio, way over 60%. So this is an interesting time to look at the fund, we think.